Good morning. Business finance. We're all the way up to chapter 7, week 6, which 6 out of 15 weeks sounds like we're about 40% done with the class. So just a bit of a warning. In the next week or two, we're going to get into some more complex issues. We get into things that I know I dealt with a lot in the banking world, net present values, payments, and those types of things. Often they sound more complicated than what they are to figure, and we've got so many tools now to do them that truly amazing. So in any event, just the headline here, I kind of wanted to show you a couple of headlines, I guess. Apple hits market with up to a 10-part bond. It talks about investment grade, okay, and this is kind of important. It says that there was a reawoke Tuesday the investment grade corporate bond market after a 6-day shutdown. Now, I don't know if the shutdown, I don't think there was any in particular reason that they shut down, just probably no corporations were actually offering bonds at that point in time. So when a corporation offers a bond, it means that they're borrowing money. Okay, investment grade means that they are rated at least triple B or better. Okay, triple B, the next step up would be like single A, and then double A, and then triple A, and there's derivations of each of those. And an example here is Apple. Okay, Apple's AA plus or A1. Okay, different rating companies do it differently. AA plus is a double A plus, so it's not quite triple A. You could have a triple A minus, I think, is where the U.S. government is, for example. Okay, I believe that there are only a few corporate stocks that are actually rated triple A. So kind of getting ahead a little bit, but it's interesting to look at, and it's interesting to look at the rates and whatnot. And I kind of wanted to talk a little bit about that as I cruise down or scroll down this, that Apple's testing the appetite, it should be, with the initial price thoughts of Treasuries plus 75 BP, which means basis points. Okay, basis points are in a number that's represented as a percent. It's the numbers that are past the decimal. So 10.7% would be 7 basis points, right? Okay, and if you looked at the Treasury, they say 75, 90, and 115, but you have to look at this on 2, 3, and 5-year fixed tranches. Tranches kind of means amounts, I guess. But 75 basis points then over what the Treasuries, okay, are bringing at a 2-year. 2-year Treasuries are really, really low right now. In fact, I'm not even sure. I'd have to go look up what 2-year Treasuries are trading at. I do know that 10 years, and we come down here, I'll use this one because I kind of know what 10 years are trading at. So it is also coming with a fixed rate, 10, 20, 30-year bonds at initial talk of Treasuries plus 160 basis points. Well, 10-year Treasuries were recently at about 1.7%, 1.8%. So that means that they're going to be offering this at about a 3.3% rate, 3.3, 3.4% rate in the 10-year, okay, that you and I would be able to go out and buy. That seems like a high rate to me. So, because, Apple is about as solid, I'd almost call it more solid than the U.S. government, really. It certainly has a lot less debt relative to its income. But in any event, gives you an idea of the rates and some of the terminology that we look at when we talk about this. I bring it up because it was a headline, but it's also important stuff that we're going to talk about when we get into bonds. Okay, and we're going to have a chapter, I think about chapter 10, where we're going to talk about bonds and bond rates and pricing and how those things are all affected. Okay, and so a little ahead, but going with a current article about something that we're going to talk about later. Why negative interest rates will fail, and what are negative interest rates? And this one I'll just give you a little quick overview, but our Federal Reserve, which is the central bank, okay, it's the bank where all banks basically, not all, but through intermediaries at least, all of our banks have accounts with the Federal Reserve Bank. It acts to clear checks, right? If you write a check or use your debit card and you're a bank, a customer of Wells Fargo, but you spend your money at XYZ Company, and XYZ Company is a customer of U.S. Bank, how's the money get from one to the other? And that's the central bank does that. But central bank also has the job of trying to stimulate the economy and trying to keep unemployment rates low. It's two. Actually, it has two orders from Congress when it was passed. One is for stable money, meaning low inflation, and the other is for low unemployment. Okay, it tries to accomplish that sometimes, and what we're in right now is in an extremely historically low rate environment, and have been since the recession really of 2007, 2008. So we're in this extremely low rate environment. Well, even that, obviously, because we've had the longest and poorest recovery in the history of recoveries, except maybe the Depression, although it's really pretty close. But in any event, they use interest rate policy. They try to get rates down because that stimulates people. People are more interested in borrowing and whatnot. And they do that. They lower rates by lowering what they charge banks at the discount window, it's called. Okay, and also lowering the rates that they pay on reserve deposits. So, like I said, they're the central bank. So banks have at least, if not directly, but through intermediaries, have accounts with the Federal Reserve, and the Federal Reserve pays them interest just like your bank pays you interest. And the federal bank lends out that money. If banks have money on deposit at the Federal Reserve, the Federal Reserve lends that money out to other entities, sometimes to the U.S. government. Well, banks, if they're getting interest from the Federal Reserve, it's considered the most secure investment that a bank can make, right? And so they don't mind leaving it there if they're getting interest. And even right now, that interest is extremely low. It's between 1/4% and 0.5% here in the U.S. Other nations have actually gone to negative interest. And what does that mean? That means that the Federal Reserve is charging banks for having money on account at the Federal Reserve. What's the goal? The goal is then for those banks to go out and find other places to invest that money, presumably places that would create more economic activity. And it's just like this. If your bank started to charge you, instead of paying you 1/4% interest, if you're getting that, if they started to charge you 1/4% interest for leaving your money there, you might say, BS, I'll put it under the mattress, or I'll go invest it someplace else. Same thing. And so negative interest rates are a method to try to push that. And of course, the article that I have here is headlined "Why Negative Interest Rates Will Fail," and I haven't read it yet, but it'll probably be an interesting argument. But I kind of wanted to run through that as we talk about finances and the Federal Reserve and their impact on rates, and the chairman of the Federal Reserve, who right now is Janet Yellen, is oftentimes considered the second most powerful person in the world, behind the President of the United States. Okay, such is their impact on economic policy and financial policy, monetary policy that we have in the U.S. and around the world. So really important. Okay, onward. Sorry for that digression, but we have. Okay, Chapter 7 assignment, we'll go through that. Problems 1, 5, 7, 9, 12, 16, 17, and of course I have samples that are similar. And we'll start with problem number 2, which is much like your problem number 1. Problem number 2 reads, a Neon Light Company of Kansas City ships lamps and lighting appliances throughout the country. Ms. Neon has determined that through the establishment of local collection centers around the country, she can speed up collection of payments by 3 days. Great. And furthermore, the cash management department of her bank has indicated to her that she can defer her payments on her accounts by 1/2 day without affecting suppliers. The bank has a remote disbursement center in Florida. You can kind of ignore the last sentence. It really doesn't have anything to do with the problem. This is a case where I think reading the problem sounds more complicated than the actual problem. It just says that we're going to speed up collections and we can delay our accounts payable. What does that mean? Well, when we do that, it means that we can keep a little bit more money in our bank account for a few days longer on average. Okay, we went back years ago when I was going through my master's program. We studied Dell computers a little bit. Dell computers, believe it or not, actually received payments for the computers that they sold before they paid for those. Okay, that maybe doesn't sound like a big deal, but when I calculated it, it actually contributed about $50 million in earnings to Dell's bottom line back then. Okay, because their average balance that they could hold extra was huge. It was like $500 million or $1 billion of extra cash that they could hold and have it on deposit someplace earning interest, right? So it was a huge difference, and as we'll see even in this problem, for a smaller company, it can be extremely important. So their collections, right? And we go look at that, right? They're 2.25 million. Okay, and I've just got 2.25. That should be million. Okay, and their disbursements are 1.05. So again, I've just set it up what my collections and my disbursements are. I'm going to save, and I just labeled this as day saved. Okay, 3 on collections. Okay, and 5 or 0.5. I'm sorry, on disbursements. All I have to do then is the math is multiply the 3 times that. Okay. It's not extra money that I'm making. It's just extra. I'm making the same amount of money. It's just extra money then that I'll have in my account. So that's 6.75, and again that's million, and 0.0525 for that. Okay, and I add those two. Yep. Just add those two up, sum them, and I come up with, I could hold an extra, on average, an extra 7.5 or 7.3, roughly $7.275 million that I could hold on my account on a regular basis. If I could earn 6%, we know by today's rates that's actually very, very high, but if I could earn 6%, my savings then, if I take 6%, 0.06, okay, my savings then is simply equal to that interest times the amount of money on average that I would have extra. And it's 0.43, or, yeah, that's million, so that's $436,500 that I would make. And because I'm calculating interest, on an annual basis, this would be my annual earnings, okay? My annual earnings for that I would earn. Okay, on an average basis. Okay, then the question further goes on to say, if it cost me $400,000 for the new system, should I buy it? And the answer here is obviously yes. Okay. Okay, I'm going to save that much in the first year alone. Even if I didn't, I would argue that even if I didn't come up with the $400,000, it still may be a reasonable investment, unless I had to invest that each and every year, right? It'd still be, if I came up with $300,000, it would pay off in a year and 4 months. That might still be very reasonable, right? After that, it would be a very much a profit center. Okay, you guys have 5, I think, and so I did 6, and I pointed out 5 that the problem is should read compute the average collection period. I don't know if there's a little confusion. It says Thompson Wood Products is for your guys is for number 5 has credit sales of 2.160 and accounts receivable of 288,000. Compute the value of the average collection period. So it's a compute what the average collection period is. I guess I wouldn't call that a value, but compute what the actual collection period is. So an example, I did number 6, which is similar, which is Oral Roberts Dental Supply. It says annual sales of $5.2 million, 90% are on credit. The firm has $559,000 in accounts receivable. Compute the value of the average collection period. I actually have to do a little bit more math for mine, okay? first it does give me what my accounts receivable are, okay? But then I have to know what my credit sales are. For your problem, it's just given. Okay, you're given both the accounts receivable and the credit sales. I have to actually calculate mine, and mine says that 90% of my sales are credit sales. So I have to take 0.90. Oops, sorry. I have to hit my equal sign first, right? 0.90 times $5,200,000. Okay, so my credit sales are equal to 4.68 million. Okay, days of the year. We use, this is fairly common to use 360 days of the year. It kind of assumes that there's 12 months of 30 days each. It just kind of equalizes things. Honestly, I think that a lot of this was done back in the day when they had to compute a lot of this stuff by hand, and it was just easier using 360, in an average month of 30 days than it was to do 365. With computers now, I'd argue that we could sure use 365, and it's just as easy. Okay, but when it asks you to use 360, please use 360. Okay, please. So I have to calculate, well, what are my credit sales per day? Well, if I have credit sales per year of this much, and I'm using a 360-day year, it's simply my total credit sales divided by the number of days in the year, right? So I can just simply take this equals my credit sales divided by my days of the year. It's 13,000. My average collection period then is 43 days. And that's the answer to my question. And similar to the answer to your question, obviously you should come up with a different number. And I put in here, if you go back to the formula, it's probably right at the start of the blue pages. They usually have the formulas in there. Gosh, maybe I lied. There it is. They do have it at the bottom of page 219, right? Kind of gives you what some of the formulas are. Yeah, usually they do a better job of putting some of those formulas in there. Maybe that's why I put it on my spreadsheet here. But that one is on the bottom of page 219, and I just spelled it out there. Okay, onward we go. You guys have number 7 and 9, and I did 8, and I think that 8's similar to both of those. Okay, so let's take a look at 8. It says Darla's Cosmetics has annual credit sales of $1,440,000 and an average collection period of 45 days in 2008. It says assume a 360-day year. What's the company's average accounts receivable balance? Accounts receivable are equal to, it even gives you the formula, right? The average daily credit sales times the average collection period. So average daily credit sales times the average collection period. So, okay, I have annual credit sales of $1,400,000 and 360-day year. So let's just put my numbers in. Okay, so my credit sales $1,400,000. My days of the year 360, because it says that. My collection period is 45 days. Okay, so my average daily credit balance, right, is equal to my credit sales divided by my my days per year. I'm sorry. Okay, so yeah, I want to figure out my daily credit balance. Okay, so I just take my credit sales divided by the days per year, and that's going to give me 4,000, right? We'll do that. This is equal to credit sales divided by my 360 days per year. I was kind of getting ahead of myself. But then, right, okay, it says my average collection period is 45 days, so I want to know what my average accounts receivable are. Well, if this is my average credit sale per day and my collection period is 45 days, it would just make sense that I got to take that times that. Okay, so my answer here for my average accounts receivable is equal to my average daily credit balance, or average daily credit sales, that should be. I'm calling it the wrong thing. Average daily credit sales times my collection period. 180 grand. Okay, I think that's similar. I think your guys is number 7. Let's see. Let me read through it and see if there's anything different. Knight Round Table Company has annual credit sales of 1,000 or 1,080,000. So it gives you that, an average collection period of 32 days. It gives you that. Assume a 360-day year. It gives you that. What is the company's average accounts receivable balance? There you go. It's asking for the same thing and gives you the answer. Number 9, let's make sure that we got that kind of covered too. Barney's Antique Shop has annual credit sales of $1.62 million, an accounts receivable balance of $157,500. Calculate the average collection period. Use 360 days in a year. So that's a little bit different, right? Okay, we know what our credit sales are, and we know that our number of days per year we're using 360, and our average accounts receivable balance is $157,500, right? Okay, but now I have to calculate what it's asking for my average collection period. So I have to figure out this, right? Well, I do know, okay, that my average accounts receivable is equal to my average daily credit, right, times my collection period. So how can I figure out my average collection, right? If my accounts receivable balance is $157,000, okay, all I have to do is take that. Hang on just a second. Okay, so for your guys's, you get the 1.6 million here, and you've got you know what your average accounts receivable is, right? Okay, but you know what your days are. Okay, so you need to figure out the first thing to do is figure out what your average daily credit sales are. So you take your total. In this case, if I took the 1.44 million and I divided it by my average accounts receivable, what am I going to get there? Well, let's take that. Okay, let's just do it down here and say this is equal to my credit sales divided by my, oh, I did that wrong. I'm sorry. Let me go back. That's not the number that I wanted. I want to figure out what my daily credit sales are. So I got to take my credit sales divided by the number of days in the year. Shame on me. So again, or not again, we'll just try to do it right this time. This one divided by my 360. Okay, that gives me my 4,000 days. You guys are obviously going to come up with something a little different. It'll be 1.62 million divided by the 360 days, and that's going to give you a different number there. Okay, then when you know that, and they give you this number, right? And this number is simply this number times this number. So if I want to get this number, it's going to be this number divided by this number, right? So if I take my equal to my 180,000 divided by my 4,000, I get 45, right? And that's the number that you guys are looking for on your number 9. So sorry, I got a little bit confused there. My numbers get jumbled. Gosh, even for me, they get jumbled a little bit. So sorry about that. Let's go number 13. You guys have what, number 12, I think, which is similar. 12, yeah. So we'll hit 13. And 13 says this. It says, Fisk Corporation is trying to improve its inventory control system and has installed an online computer at its retail stores. Fisk anticipates sales of 49,000 units per year, an ordering cost of $8 per order, and carrying cost of $1.60 per unit. What is the economic ordering quantity? Okay, I had to go and look up the EOQ, which is in the chapter, right? It gives me what the formula it is. It says the EOQ is equal to 2 times the sales, okay, times the order cost divided by the carrying cost, and then I have to take the square root of all of that. Okay, so I've got my formula here, and then and I'm going to put in my numbers. My sales in units are 49,000. My per order cost, okay, is $8, and my carrying cost is $1.60. Okay, so I'm gonna do the top part of this equation first. Is what I decided to do. I could take 2 times my sales, right, which would be 2 times my sales in units. What would that be? 98,000 times, okay, oops, I've got I'm sorry, before the square root. So I've got, and I could break this down even further. Let's do that. So let's say that I want to figure out first my 2 times my sales. So that's just equal to 2 times my sales of 49,000. Okay, it's 98,000. And then I take that times my ordering cost. So this is equal to my order cost times my 98,000. Yee, big number. Okay, and we'll get rid of those decimals and make it a little bit easier, and we'll also get rid of the, I should have there. Okay, so 784 is the top part here, right? But then that's divided by my carrying cost of 1.6, so equal to this divided by this. Okay, and I end up with, okay, what I have here, 490,000. Okay, so that's all of this inside of here, and then I got to take the square root of that. Okay, how do I do the square root? There's 2 ways actually you could do a square root. I'll show you both real quick. Okay, one way is come up here and hit this, and get used to doing that, because in a couple of chapters we're going to be doing that often. Okay, and you can see it kind of gives me different things, and you can also just come here, oops, and kind of highlight that and type in SQUAR root, hit go. Ooh, look at that, square root, SQURT, hit OK. It just says the square root of the number. Well, this is the number that I want the square root of, so I just click on that. It tells me an answer there. It's kind of cool, and that is the right answer, I know that, and so I just hit OK, and it's going to input that number in there. Okay, another way to do that, and it's sometimes easier, sometimes faster than actually going up and finding the square root, but you can say that it's equal to this number, okay, and then hit my shift and hit the 6 key that's up above your keyboard, and it's got the little tent on it, right? So you hit the tent, okay, and then I can go this, and what this is doing is it's taking this number to a power. If I was going to square this number, okay, 490,000 times itself, I'd put 2 in there, but because I want the square root, I'm going to put 1 divided by 2. Okay, and that's the same thing as the square root. Hopefully I'm doing this right, and my answer should come up to be 700, just like it is there. Ooh, I got lucky. Okay, and so that's another way to do that. So there's a couple different ways that you can do the square root. Whichever one works for you is just fine. Okay, so then we have that's our economic ordering quantity, which is our answer for number A, right? How many orders will be placed during the year? Well, let's see. It says carrying costs. Yeah, how do we do that? Well, we take our sales in units, right? Okay, that we're going to have 49,000 in units during the whole year. The economic ordering quantity, or the quantity that we can order that makes the most sense, that keeps our cost the lowest, is 700. Okay, so how many times do I want to order per year? If I'm ordering 700 at a time, it's just 700 divided into my units. Got to be careful, because that one's sitting right there, but it's divided into my units per year to get my orders per year. So this is simply equal to my sales in units divided by my EOQ, or economic ordering quantity. So I'm going to order 70 times. Okay, I'm going to order 70 times. And then it asks, what's my average inventory? So I'm ordering, what, about once every 10 days, something like that, right? So my average inventory, though, is simply equal to my economic ordering quantity divided by 2. Okay, because what I want to do, right, I'm going to get 700 units in. Trying to demonstrate that. I can't draw very well here, because if I had my other tablet I could, but so I start here with 700 units, right, and I sell it, and I sell it, okay, and I sell it, and I should get down to 0 and get 700 again, boom, right, And so each time I do that, it's really the midpoint of that, which is going to be half. So it's just my average inventory is my economic ordering quantity divided by 2. There we go. Okay, I think I've got one more question. What is the total cost of ordering and carrying inventory? Well, okay, so my total cost for the year, I got 70 orders, and it cost me per order $8. So every time I place an order, so 70 orders, it cost me $8. Okay, so 70 times 8. This is simply equal to my orders per year times $8 a whack. Okay, 560. My average inventory then is 350 units, and my carrying cost is $1.60. So equal to my average inventory times my carrying cost. Oof, got all kinds of funky decimals there. Let's get rid of some of those. Okay, and then it's just my total there, right? So that's simply equal to my total, sum of those two, boom. And I should probably highlight that too, since I got 4 answers there. Okay, onward. Again, it reads, the math's not really difficult there. It just reads kind of funny, and you got to make sure you write it all out and make sure it's you follow the steps. Okay, onward. 16, which you guys have 16 and 17. So I must have done similar problems and just used different numbers, I hope. Let's find out. I did. Okay. Good old Wisconsin Snowmobile Corps considering a switch to level production. So they must be doing some seasonal production where they bring people in and then they pay them overtime and stuff like that. Cost efficiencies would occur under level production, and after-tax costs would decline by $36,000, but inventory would increase by $300,000. So you're going to make more during the off-season, right? And you're going to accumulate inventory. Wisconsin Snowmobile would have to finance the extra inventory at a cost of 13.5%. Determine the extra cost or savings of switching over to level production should the company go ahead and switch to. Okay, how low would interest rates need to fall before level production would be feasible? So let's just change the numbers, and let's just say, okay, Wisconsin Snowmobile, they could save $50,000, right? So cost savings, 50 grand I put in there. But I'm going to increase my inventory by 600,000. I'm using a 10% interest rate. Okay, so my interest cost, let's calculate that first. In your guys' case, your inventory is increasing by 300,000, and your inventory cost is 13.5%. In my case, it's 600,000 and 10%. So it's just simply equal to the 10% times my increased inventory. So I'm going to have $60,000 in increased costs, but I save $50,000. Ooh, well, and the way your problem reads, you know that your answer is going to be similar, right? That your increased interest cost is going to exceed what your cost savings are. Okay, you can kind of tell that by the way the problem reads. So, bummer. I'm not gonna make any money doing that. But what if rates went down, and to what point would they have to go down in order to make it break even, right? Okay, and so well, how do I calculate that? Okay, well, if this is my cost savings and this is my increased inventory, what happens if I take and I go, this is equal to my cost savings? Because what if this were my interest? Let me go back and rethink that, right? I'm taking my interest rate times my increased inventory, and there's my interest cost. Well, let me just give you a sample here. So what if I take this and I divide that by my increased inventory? Ooh, I get 10%, which is my interest rate, right? Okay, so if I had to have an interest cost of less than 50,000, okay, couldn't I just take my 50,000 and divide it by my increased inventory, and that would give me the rate equals my 50,000 divided by my 60,000, 8.33, and actually those 333s would go on to infinity, right? So I'd have to have a rate better than that. Okay, 8.25%, 8%, to make it worthwhile. So That's the number that I'm looking for. Over here I just did a confirmation, so I could say this is equal to this, right? Okay. And then to make a confirmation, I just take this is equal to my interest times my increased inventory, and it should be 50,000, right? Okay, onward. Ooh, a little bit longer problem, but nevertheless, I don't think all that difficult. We just got to set it up properly again. Johnson Electronics is considering extending trade credit to some customers previously considered poor risk. So we're going to try to sell a few more things, but we're going to take on some more risk. Sales would increase by 150 grand if credit is extended to these new customers. Of the new accounts receivable generated, 5% will prove to be uncollectible. Additional collection costs will be 2% of sales, and production and selling costs will be 74% of sales. The firm is in the 35% tax bracket. Oh my God, a lot of information, but let's just break it down, okay? And I used different numbers, but it's the same thing, okay? So make sure you set yours up. Make sure you use all your numbers, right? Mine are a little different, okay? And my result may be a little different, but so I'm going to use sales of 100,000, and then what I called cost of goods sold, okay, is the same as what your guys' production and selling costs would be, right? And that basically is a cost of goods sold, okay? And I use 79%, so I entered it like this, and I had my percent here, and again I entered that as 0.79. And if you want to make it look good, you hit the percent thing up there, so it changes that. And then this is simply equal to my cost of goods sold times my sales. Okay. So that tells me that if I have $100,000 in sales and my cost of goods sold are $79,000, I'm going to have a gross profit that's equal to my sales minus my cost of goods sold. Okay. Now, because I'm taking on some riskier customers here, I'm going to have some uncollected accounts. So I'm going to have to write off some of these things. And we got to be a little careful because this is based on my sales. And I used 6% or 0.06. Your guys is 5% or something, right? But that's based on my sales, okay? And I'm going to enter that in as a negative number. You could do it as a positive number and just make sure you do the math correctly, but to me it looks a little bit better as a negative number. I could have put my cost of goods sold in as a negative number up here too, but so instead of hitting the equals, I can just hit my minus my 6% times my sales, okay, not my gross profit, my sales, and I get 6,000. And I do the exact same for here. I'm saying that my collection costs are an extra 3%. And my collection costs then, based on my sales again, is a minus the percent times my sales. So 3 grand. Okay. So how much more money I'm going to make is my incremental, we call it EBT, or earnings before taxes. Earnings before taxes. So that's just simply equal to my gross profit minus my uncollected accounts and minus my collection costs. So 21,000 minus 9,000 basically, but to do it correctly I would say, and I can just sum these because it's actually plus these since I've got these entered as negative numbers. I can simply go auto sum. Okay, I don't want to get the whole thing, I just want to get from here, so I can click on that, left click, and then drag it, so I get those three, hit enter. Okay, so my earnings before taxes, my incremental earnings before taxes are 12,000, but I got to pay taxes of 40%. Why I put that here instead of over here, I don't know. I guess it doesn't matter. My taxes are based not on my sales, but they are based on just my incremental earnings before taxes. So it's simply equal to, or a minus, my 40% times my earnings before taxes. Okay, so I got $4,800 in taxes. So again, my net income then after tax is my earnings before taxes minus my taxes, or the sum of those two, because I've got that entered as a negative. Okay, boom. So I make $200 more. My return on sales, okay, return on anything is just net income. Boom, I've calculated my net income. Return on anything is net income divided by whatever. So in this case, I'm saying return on sales, so it's net income divided by sales. So this is simply equal to my net income divided by my sales. Should give me my return on sales, 7.2%. Oh, well, that was not that bad, really. Okay. I got compute the incremental income after taxes, so I've done that. Okay. What will Johnson's incremental return on sales be if these new credit customers are accepted? So I've done my return on sales. Ooh, but now it gets a little bit more complicated. It says if the receivable turnover ratio is 3 to 1 and no other asset buildup is needed to serve the new customers, what will Johnson's incremental return on new average investment be? Well, what that's saying is that when I take on these customers and I allow them to pay via credit, okay, I'm going to have a bigger accounts receivable account. I might have to go borrow that money, or I'm going to have to take it out of money that I would use for other things. And so I want to see what my return on that investment would be. Now, I said that I have a receivable turnover ratio of 4. Okay, your guys is 3, right? But mine is 4. Okay, and so what I need to figure out then is what my average accounts receivable is going to be, right? Okay, my sales are going to be 100,000, and I'm going to turn my receivables over 4 times a year, which, how to best explain that? I guess it's easier just to do the math than really try to explain it. It's what my average accounts receivable is going to be then is simply equal to my sales divided by my turnover ratio. Okay, you'll calculate yours the same way, of course, with different numbers. Okay, that tells me what my average accounts receivable then is going to be. See, and if 25,000 times 4, that's my turnover, should equal my sales. Okay, working it backwards. But now I got to figure out what my return on my incremental investment is. Okay, this is what I have to invest. This is the money I have to take out of other things, okay, or I have to borrow it, or I have to do something, right? I have to take it from somewhere else, okay, an opportunity cost, and I'm going to invest it into these new accounts, right, that are maybe a little more dangerous, okay. Is it worth doing? Okay, so I'm comparing this then to some other investments. Well, how do I calculate that? Again, return on investment. This is my average accounts receivable, but it's also my investment. So return on, remember, is net income divided by whatever that thing is, in this case investment, and this is my investment. Okay, so I simply have to say that this is equal to my net income divided by my investment. 28.8%. That's a hell of a return. I think I'd go for that. Okay, unless I could get 35% someplace otherwise, right? Your numbers obviously may come up to be something completely different, right? So, but if you work through it and you follow the same deal, the same format, you should be able to work through it pretty easily. With that, I'm gonna close up. I'm getting a little long-winded here anyhow. You guys good luck with this assignment, and we'll talk to you again soon.